All right, James, ready?
Yep. Alrighty, let's go. So,
All right.
hello everyone, and welcome to our eighth Coast-to-Coast meetup. Yes, we have 7 other ones in addition to a few other ones. So, if you are interested in looking those up, feel free to check out our Facebook group, which will be shown on a few slides. But this is a special webinar as it is the kickoff of a new series that we're calling the Real Estate Fundamentals. Referencing those past webinars, especially our co-investing meetup series, which is a separate series, we delve into some pretty advanced topics at times. We have a lot of smart people in the room, not myself included. And in this series, though, we wanted to sort of get the other side of the coin, so to speak, and wanting to educate those that are either new or simply exploring the real estate investing industry as a potential addition to their investing portfolio. So we're all once beginning investors, and what we aim here to do is to combine data, educated perspectives on data that we see, and where appropriate, real life examples from our own investing experience to provide some context and anecdotes to those fundamental concepts that we're aiming to convey. And all of these webinars, no matter what series they are purely educational, aimed to really give to the investing community. We are involved in a lot of groups, and it's really just continues, even after all these years, just really blows my mind how open and generous people are, specifically in the real estate industry. So we really want to perpetuate that and pay it forward as much as possible, while also being paid forward too. And really just enjoying and sharing what we can in this, what I believe is a wonderful industry. So without further ado, let's move on to the next slide. We'll see the wonderful panel that have been contributing to these Coast-to-Coast webinars. On this series, or rather this specific webinar in this series, we'll be introducing the panelists, myself included, on the next slide, which will be the M5 Capital Group team, which is Vivek, Henry, and myself. So as far as introductions, Vivek, tell us a little bit about yourself and just a brief introduction.
Yeah, thanks, James. My name is Vivek Arza, based in San Jose, California. I'm first and foremost a technologist, love data, love numbers, love my job. But over 2.5 years back, I started investing in real estate, in single family homes out of state. The first home that I bought was a foreclosure home, and then have been trying to expand on that business model for about over the last 2 years. I have a portfolio of single family rentals in Kansas City, along with my partners, Henry, James, and a few others, looking to scale into multifamily properties because of the business like evaluations, and also the scaling capabilities are much better there. Really looking forward to launching the series with you all and learning concepts from the fundamentals to the advanced ones.
Great. Henry?
All right. Hi, everyone. I'm Henry Yen from Seattle. I'm a dad, an aerospace engineer, and a real estate investor. Started investing in real estate about 10 years ago and have a small portfolio of single-family rentals, and finished some fix and flip and single-family development projects. My team currently has a superhost status with Airbnb as well. And last year, shifted kind of my strategy towards multifamily and commercial real estate for 2 primary reasons. First was I'm actually looking to develop multifamily projects on my own properties. The second reason is also kind of believing in commercial real estate and thinking that it is one of the best asset class out there with solid risk-adjusted return and a good hedge for inflation. So we'll cover some of these topics today, why investing is in real estate is appealing to me. I'm happy to share what I learned.
Great. Thank you, Henry. And I'm James McCrae. I'm based in Orange County, Los Angeles area in sunny Southern California. It's very sunny and hot right now. But I've been in investing for about 3 years. I started really just right out of college. Started my own company out of college too. So I was really involved in a lot of different things. And I wanted to get more of a passive side because starting a business is not the most passive of things. And but it stumbled upon real estate and was really trying to explore different avenues. And I really quickly stumbled upon or really discovered commercial real estate, and really kind of stuck with me ever since. And I've been having a specific focus on that for the last year or so, and I've been working with Henry and Vivek and a few others, as they mentioned, looking at mostly multifamily, but also a handful of anything from hotels to self-storage deal to senior housing. So it's really quite fun. I think the commercial area has a lot of diversity in its own respect. So, but I'm always connecting and learning every day, every single day with people I meet on Facebook now, predominantly, but also meetups in person, and really just enjoy learning about people's goals and what they're looking forward to. And that's why I really enjoy sharing what we can and to help other people enjoy the journey as well.
Awesome, thank you.
Absolutely.
So, all right. So, if you like to have a chat about real estate or meet up for coffee or when we get to go out again or virtually, please reach out to us. And here's some of our contact information. We also include other panelists that are not here today. They're from different parts of the state as well. So you might be able to reach out to them as well. Also, want you to come check out our new Facebook group called the Coast-to-Coast Real Estate. We will be announcing when our next scheduled events, share some news and articles in real estate, but also for everyone to network with each other and meet other like-minded individuals who also caught the real estate bug. That we'll come back to the contact info at the end of the presentation, so you have that. And also just a housekeeping and legal. So a lawyer wants to make sure, keep us out of trouble and make sure we go over some of these disclaimers. But also for housekeeping rules, feel free to type in your questions in the Q&A box. So we'll be answering that throughout the conversation or at the end. And if you'd like to speak, you can also use the raise your hand feature. So at the end of the presentation, we'll get everyone an opportunity to speak as well. Also, this presentation is being recorded, and so you will get a copy. And this is not a solicitation to purchase an investment, and this is just for education only. And always verify the information that we're sharing with you and conduct your own due diligence. That, let me continue to talk about our goals for today. We will, we all have friends who are interested in real estate or maybe sitting on the fence and not sure whether real estate is right for them, or you might know someone who became a landlord by accident or just want to understand the game better. So if you already invested in real estate, that's great. And just are you taking all the good full advantage of it? And so we just wanted to, share our experiences, and also wanted to go back to the basics and answer some of these questions. Why is real estate appealing to investors? And what problems do we see in the society today that made it more crucial to hold some of your portfolio in real estate? We will also talk about the benefits of real estate investing and share a real example for rental properties. We also will be talking about the pros and cons and examine what are the drawbacks in investing in real estate. And finally, we also wanted to ask if there is a completely passive investment. So let me turn it over to Vivek to talk about the big why and how.
Yeah, thanks, Henry. Since our topics are focused on real estate in general, we want to ask ourselves, why are investors looking beyond stocks and bonds? Because traditionally, we've been told that stocks have to have some allocation, bonds have to have some allocation, and then some cash. Why are traditional investors looking beyond stocks and bonds? The reason is, the reasons you will learn throughout the webinar today. The second question that we want to answer is, why should you seek higher yields than the 2% bond market or the 6 to 7% stock market? Why can't you be happy with that? That's the second question we want to answer. And the third question is, how can you do it? Are there different investment vehicles you can invest? One of them being real estate, to achieve a little more higher returns than stocks and bonds. And also in a risk-adjusted fashion, both actively and passively. These are the three questions that we would like to answer through this webinar. Let's get started with what we've been told, especially the traditional retirement system. We have the 401ks as the baseline. The 401ks were designed for an age or a generation where people did not live as long as they're living today. The good part is people are living longer. The good part is people are living longer. In 1900, you lived to an average of about 49 years. So the day you worked, the day you died was essentially when you were still working. In the 1960s and 70s, your average lifespan was about 69 to 70 years. And the retirement had to last only a few years because you retired at 60 or 65 years, and then you had your nest egg and you can live off that. Today, people are living due to medical advances and better healthcare, better nutrition, and many other things. People are living to the ripe old age of 79 or 80 years, and for women, it's good news. The average lifespan is about 83 years. So the retirement nest egg that you save up or invest, that has to last decades and not just years. Next slide, Henry. Combined with the longer lifespan that most Americans have, there are rising healthcare and educational costs. If you see the graph on the left, the left side shows the green line there. That's the actual college tuition and fees, which has risen over 1,200% since the 1970s, since the 1980s. And if you see the right side, your medical expenses are not getting any cheaper. They're becoming even more expensive every year. And most Americans who are self-employed don't even have employer-based coverage. So these two combined are not getting any cheaper. Your nest egg has to be able to support it. And you better get some gains which can grow your nest egg to a suitably high value that you can support your children's education and also your healthcare bills as they come up more and more towards the end of your life. I think James will be covering the next slide. It's about what the stock market returns have been looking like over the last 2 decades.
Thank you, Vivek. So we'll be getting into a little bit of math, but that's sort of by intention because real estate is actually quite full of math. So it's something definitely to get familiar with, comfortable with, and hopefully proficient with. So when we talk about returns, there's a lot of different ways that people can look at returns, pre-inflation, post-inflation. Here we'll be talking about adjusted for inflation, but you have time involvement or just absolute values. So there's a lot of things, and we'll be covering some of those things in future webinars, but this is just one snippet of that. And so I want to here distinguish between kind of what we hear from the stock market of your average return and really how that is not necessarily indicative of an annualized return in terms of a CAGR, what's called a compound annual growth rate. So as an example, if you have an investment that went up 100% one year and then came down 50% negative the next year, you could say the average return is 25% because if you do the math on a basis, but in actuality, your principal is really back to where you started, and so your actual CAGR is actually zero. So that 25% is what's called an arithmetic average or a simple average or arithmetic mean. It's what the CAGR is really getting at is called a geometric mean, and it really it's pays to go through examples, and we can certainly do that if anyone's interested, but it has to do with your basis and your what those returns are being based on and how that affects and the time that those changes are being made. So but essentially, so here's one example. Here's the average stock market returns over the last decade. And this nifty calculator found on moneychamp.com shows you can play with it and put different ranges, adjust for inflation, include dividends, all that to really get slice and dice it, as we like to say. But what I try to highlight here is taking into account that geometric mean, sorry, the CAGR, excuse me, that you're really only growing a dollar, for example, or to about 110%. So it's not that much, to be quite frank. But the significant pattern is essentially this: over the long run, the stock market has had an inflation-adjusted annualized return of between 6 and 7%. But they have been over inflation, so your money is certainly growing, but they've done not as good as some other alternatives that we'll be discussing next. And especially does poorly in high inflationary periods, which have or various periods such as the early teens, the mid 40s, and the late 70s in our stock market history and in monetary policy. On the next slide, will be kind of 2 tips to take into account this CAGR and really how that basis that I mentioned really manifests itself when we add in the time component or compounding returns. And as I mentioned, there's a lot of different types of returns. One's called an IRR. It stands for something. There's a lot of acronyms in real estate, but we'll probably be talking about that in a future webinar, if not the next one. But here, I just want to illustrate the power of compounding interest, so to speak. That may be a familiar term with many of you. A lot of financial experts and gurus, if you want to call them that, really exacerbate that, really emphasize this point. And this is a simple example of looking at a sample $100 investment. It could be 100K, it could be $1 or $100 over 30 years. And that time is very important, that 30 years. So that's arguably a very long time. So we have a 2%, an 8% return, annualized return, or a 12%. And that 2%, as Vivek mentioned, is kind of what you can expect from CDs. Not really right now. They're kind of like 1.3% right now. So in the 90s, perhaps. The 8% is kind of, a very well-performing like mutual fund or ETF, for example. 12% is actually pretty standard for a real estate investment. And we have a real-life example from one of the panelists today that will show how that is possible. But what I want to show here is that on the 2% is we see that $100 growing to 182. Not bad, but it took you 30 years to get there. So it's not exactly the fastest thing. At the 8% level, however, we begin to see the power of time and how you can see that 4x in annual return going from 2 to 8% resulted in a 10x. So the time is really your lever. You're compounding your investment and leveraging that initial basis by compounding it. At the 12%, it's even more, the chasm is even wider. You do a little bit more in annual return, but the time just leverages that. So you have a 6x in annual return between 2 and 12%, but a 30x in your overall return. So it's pretty significant. So really just emphasizing that time is really important. And that's why it's so important to get started as early as possible, because your return requirements would be lower to achieve a certain target if you have time on your side.
Yeah, that's right. That's a good point. I think we do have a question from the audience. If you'd like to go ahead and ask your question. Yep. Okay. Or we could wait away to the end. We can also do that as well.
Do that as well.
Okay. Yep. All right.
So, okay. Our second tip on the next slide is a not as talked about component, but it's the effect of volatility. So this is, I remember when I talked about your basis. So if your basis is increasing, then your leverage upon that is also increasing. And so that we can see a gap in the graph between if you have an increasing basis, rather a spiked in increase and decrease. So it's maybe a little bit easier to see this in a tabular format of looking at each year's growth rate, but really this is just the end result of that. So essentially, if you do that, the arithmetic, you have a 20% gain in 1 year and a 10% loss in the next year. Not entirely unlikely, but overall you're quote unquote 10%. But it's really bouncing all over the place. So your basis, again, is changing. Whereas in a stable, always 10% positive, your basis is always growing. So that increase in basis is self-leveraging itself to increase your returns even further. And over time, 20, 30 years, it's going to be a sizable difference between here, it's approximately $200,000. So it's nothing to snuff at. So those are just kind of simple investing principles, not necessarily applicable to real estate only, but definitely widely used in underwriting properties and projecting returns for investors. So it's definitely something to keep in mind. And I will turn it over to Henry to talk about some of those returns I mentioned as they might be compared to some quote unquote traditional investments.
Thanks, James. So I think this, oh.
Yeah, that was just, I was
sorry.
doing we can pass it on. It was a
okay,
second.
It was just, all right. Okay, so yeah, it's a little bit of difficulty with the charts here, but talking about the benefits of real estate investing, we also look at the annualized return. When we look at the annualized return for over 20 years, commercial real estate, it's a solid performer kind of relative to bonds and equities or stocks, and it's because it has much lower volatility that James mentioned than equities. So also just look at the stock market the last 2 months. We see the S&P 500 was at 3,300 in February, lost a third by late March, and now went back up to 3,000. So the market is still 10% below where it started. But you can see the volatility is just so huge we're in an unprecedented time, but that's just kind of show an example of that. And in commercial real estate, we have not yet seen the significant drop currently in prices, and it has held relatively steady with the rent collections. That all kind of depends on which asset class, of course. In retail, it's not doing as well as in multifamily. So that's one of the reasons why we believe that multifamily is one of the stronger asset class. All right. And this second chart, it's talk about going to the comparisons. Oftentimes we ask how we determine commercial real estate outperforms the equity and bond market. So even though most real estate is not traded openly in the market, the closest to real estate or the proxy of real estate prices is REITs, REITs, which stands for Real Estate Investment Trust. REITs are companies that own and operate real estate and generate income. So in 2019, REITs actually have a combined market cap of more than $1 trillion. Just like the stock market, though, investor can buy and sell shares of REITs on the open market. So on average, it still has quite a bit of market volatility, although it's less so than equities. It's only a proxy to real estate prices, but we can have more of an apple-to-apple comparison when all these instruments or these asset classes are traded. And you can still see that the REITs are doing quite strong relative to the other large cap, small cap, and even bonds. And it also behaves differently during different types of inflationary periods. So first of all, I'm not suggesting that everyone should dump their stock and buy real estate, and past performance is not indicative of the future. But there's sorry, it's my phone. Also, there are a handful of tech companies, that outperforms even the best REITs in the past 10 years. But I would suggest adding real estate as an asset class in addition to other paper asset. Real estate might be boring and grow steady, but real estate does exceptionally well during certain periods of time, especially during high inflation. So the prime reason is that the debt is often amortized over 20 to 30 years at a fixed rate. So during periods of high inflation, commercial real estate would see rent increasing, but the borrowing cost is fixed. So it's much better to be a borrower during inflation, and than it is to be a creditor. And I believe that I.D.E.A.L recently also did a presentation in mid-May, and he also it's sitting currently in the inflation camp where our market is heading in the future. So there's definitely a lot of people believe that the U.S. will have another inflation of asset prices because we have so much money printing by the Federal Reserve. So we saw that after the Great Recession in asset prices. This is still subject for much debate, and I personally believe that we might still have a deflationary period before we get to inflation or maybe stagflation. We might have to reserve that for future topics. But when we emerge out of the current recession, of the current crisis, I believe that we should still see real estate prices to rise again. And in this chart, you see that during the during high inflation period is not easy for investor, and real estates are doing quite well relatively to the other asset type. And with that, I think I will turn it to Vivek to talk about this.
Thanks, Henry. Yeah, I mean, I do agree that we are in a period of certain deflation right now because of consumption reducing, but with the trillions of dollars that the government is dumping on its citizens and companies, there's bound to be some inflation on the back end of this recession. Yeah, thanks. So essentially, the last tip that I want to go over is investing in assets that produce a stream of income from what's called cash flow is really what puts money in your pocket. I mean, whenever I think of this, I'm reminded of a quote from Warren Buffett, the legendary value investor. He says, "If you don't find a way to make money while you sleep, you'll be working till you die." So essentially, you have two kinds of financial situations for depending on the net worth of the families that I'm trying to show in this slide. The first kind of net worth is the low to medium net worth, who have a lot of expenses and they have a lot of liabilities which strip cash out of their pockets, and they really don't have any assets to show. And also there's nothing that brings in more earned income into their pockets. All of their earned income becomes expenses, and their liabilities take a sizable chunk of their cash flow out of their pockets again. On the right-hand side, however, you have earned income which pays for your expenses. It also acquires assets, which in turn puts a lot of passive income into your earned income, into your pockets. And that in turn goes as a cycle and buys more assets. Now, these assets can be stocks, can be bonds, can be properties, can be real estate and notes, anything. But essentially, that's the stream of passive income buying more assets, which in turn puts more passive income into your pocket. And that's how you increase your net worth over and over again. Essentially trying to, kind of compare and contrast the two kind of mindsets here.
Yeah,
the next slide.
I just want to, an analogy I think is pretty helpful that I've heard is, you can imagine your earned income on that left box is kind of like you're paid in seeds, like farming seeds, and you can either eat them like popcorn, or you can plant them and to build to grow a tree that can produce more seeds. So you don't have to keep working for that seed. That seed can eventually be produced by what you planted. And when I was talking about time, that time is what grows that initial seed, so that it produces one seed the one time, and you can grow more seeds after that, and it produces 10, 100, kind of keeps multiplying and feeding itself. So that's just one example. It's like growing your wealth. We're growing trees, growing wealth. But it's like, if you add time to $1, if you can plant it into something, an asset, it will grow over time. But it's just, you just have to have time on your side. I know I keep saying that, but I think it's true.
No, absolutely. I mean, It's not, compound interest is not called the eighth wonder for nothing, right? I mean, time is your friend when you're compounding your earnings. So yeah, thanks for adding that, James. Sure. Let's go to the next slide. The next slide essentially shows I want to go over a property example because Single family rentals are pretty much the first or the most easy to understand sort of investment example. Again, the numbers that I'm showing here are just indicative of what past performance is. It's not guaranteed that all properties perform to this standard or this metric. Just want to go over an example of a property that that is typical in the Midwest. So this property you can purchase for $100,000. It's not in the Bay Area. It's not in Los Angeles. It's not in Seattle. So it's the Midwest or the south of the country where properties do trade for this price. You put about 25% down, which is about $25,000. You get a loan for about 4.5%. That's a total of $75,000, which is usually called 75% LTV, which is 75% loan to value, the value being $100,000. What expenses can you expect if you buy a property such as this? Your biggest expense is going to be your mortgage payment, which is usually which computes to about $380. Your principal pay down. So your mortgage has two components, principal and interest. Your interest is usually higher at the initial stages of the mortgage. So your principal pay down in the initial years is about $100 a month. Your property taxes are another expense that you pay to the county. That comes up to about 1.5% to 2% of the property on an annual basis. That's about $125. Insurance, repairs, and vacancy, they total about $75 and $120. Again, vacancy is when your property is not earning any rental income. The last expense that you might have is a property manager, because you don't want to invest in a property and then have to fly every week or take care of small things that come up. You typically pay about 6 to 8%, let's call it 8%. So your monthly expenses total to about $750 to $760. This property pulls in about $1,000 of rent a month. So what you have is a net cash flow of about $200 a month, call it $220. That is what you put in your pocket every month after factoring in all the expenses and getting a rent of about $1,000. If you see why we call in a real estate an ideal investment, this example shows why it's called that. The I stands for income through cash flow, which is the cash flow that you're putting into your pocket every month, which is $220 here. Depreciation is something that the IRS or the revenue system gives a legal way to depreciate your assets because it's a business expense. You can depreciate your single family residences over 27 years, meaning you can take 1 by 27th of the value of the building value as depreciation. Again, this depends on counties evaluating the property and everything, but a CPA can add more color to this. Equity buildup is essentially the principal pay down. So every month your tenant pays rents, you own a little bit more of the property because they're paying towards your mortgage as well. Appreciation, the market appreciates every year. It does go down in certain years, but usually real estate follows the inflationary pattern. If inflation is 2%, it grows 2%. Certain markets in the coast do see a swing of 10, 20% one year, maybe 5% drop every other year, but that's more of the demand supply equation. And the last factor is leverage. You could not buy stocks worth $100,000 by getting a loan at a 4.5% interest from a bank and only putting $25,000 down. That's the beauty of real estate, is it allows almost up to 70 to 80% of the value of the property to be levered. And that kind of magnifies your gains, but it also works on the other side. If you're over leveraged, then your investments can go the other way. I hope this gives you a little bit into what the meat and potatoes look like from a single family rental perspective. Again, just trying to add color to why it's called an ideal investment. I standing for income, D depreciation, equity buildup, appreciation, and leverage. Let's take a look at fine, you're putting $220 a month into your pocket. So what does that mean from a returns point of view? Let's go to the next slide to see what the metrics look like. So those are the correlations that you're mapping there. So your total investment was $25,000. That's the cash that you put into the property. Your yearly cash flow is 220 times 12, which is about $2,600. What we like to take into account in real estate is the cash on cash return, which is how much cash did you make every year as a basis of whatever cash you put as an investment. In this case, that is 2640 over $25,000, which comes up to about 10.5%. Let's call it 10% for convenience sake. So your cash on cash return is about 10%. Your appreciation, as I already mentioned, is about 2 to 3% based on how inflation is looking those years. Depreciation can add anywhere between 1% to 2%. Again, really depends on how the county assesses your property in terms of the land value and the property value. That's a topic in itself. So combining everything, you see a total return of about 14 to 15% for this single family home. Again, this is just an example of a property in the Midwest that we constantly look at. This is not a multifamily property or an apartment complex, just a single family property, because this sort of explains all the metrics very well and kind of gives you what kind of returns you can expect from a multifamily perspective as well. I hope that added a little bit of numbers and meat to the presentation.
This is great. I wish someone explained to me when I first started in real estate. I invest even more into this segment. Yeah, I kind of fell into it. But one thing that you kind of briefly mentioned about how this is for single family and if for commercial. I mean, we don't want to necessarily go too deep into the commercial in real estate investing in this presentation, but I kind of see from this chart where we saw for single family example, this one we have about a 75% of expense ratio.
Correct.
And I think we see commercial, we've been underwriting roughly in the 50%, right?
Right. I think the expenses here include the mortgage, Henry. So usually on our underwriting, we don't add mortgage as one of our expenses into the expense. That's usually on the 50% side, right?
All right. Okay. I see. I see. That's the mortgage payment ratio. So it'll still be somewhere in the 40-50% range.
Correct. So when you compute your net operating income on commercial, you usually don't include your mortgage. I think that's skewing this a little bit on the 75% expense ratio.
Oh, got it. Yeah, I see. Yeah, I would be expecting that the commercial would be significantly lower, and that explains it too, because of the mortgage payment is a large percentage of that.
Absolutely.
Yeah, but also in commercial side, we saw a lot bigger depreciation. We could take bonus depreciation by right off the pretty much the building in the year one.
Right. I mean, depreciation has a lot more weightage on the commercial side. You're right, Henry, because here you can only take so much. But on the commercial side, you can do something called bonus depreciation, which was a new law that was passed as part of the Tax and Jobs Act of 2017-2018. So that adds a lot of tax deductions into the investors' pockets. Even though they made positive cash flow, they can get a negative form from the IRS because they took that depreciation.
Yeah, so essentially you can maybe even not pay any tax on your first year.
Exactly, on the first year, yes, first few years maybe. Yeah, it really depends on how much. Right. Yeah, legally not pay taxes. Yes. All this looks really good on paper, but are there some drawbacks to real estate investing? Again, if you can go to the next slide, Henry. Yeah, I mean, there are definitely some drawbacks of real estate investing. We're not saying that that's the best kind of investment. What are some of the drawbacks? It's definitely a lot less liquid compared to other investment types, meaning one day you can't see that the price of your property dropped 20%. I mean, that doesn't happen usually. it takes a lot longer than that. But you cannot sell at the click of a button because you have a immovable asset that you have to dispose of. It does take a lot of higher initial investment, meaning stocks, you can probably purchase a single stock or a couple of stocks for a few $100s, maybe thousands of dollars. But on commercial real estate, or the example that we were seeing, it takes a sizable portion of investment, more close to the 25 or 50,000, depending on the kind of asset you're purchasing. It does have a longer or a steeper learning curve, I should say. It takes more research into what kind of assets you're investing in. It's essentially investing in sort of a business where your business is running the rental or running the real estate portfolio. Also, management can be challenging, which is why on the commercial side you have professional teams running day-to-day operations, and you kind of manage the manager. So that can be a little bit challenging because it's, again, very close to a business compared to just investing in the stocks and just not being able to control any part of it. Those are some of the drawbacks that real estate investing does have, but it's a good way to analyze what your risk return profile is based on the drawbacks and the returns that you see. And I think that's really my last slide regarding real estate investing.
Yeah, and it's there's no one perfect asset class or investment industry. It's at least my philosophy is diversity, and having the pros and strengths of one sort of buffeting or hedging, so to speak, the negatives or weaknesses of others. And that's definitely a topic for another webinar. But it's just real estate does have its place in many people's portfolio, if not everybody. So, but it's just to be aware that it is quite unique. It's definitely not very similar in terms of because it's a tangible asset and it's all the things that come associated with that single fact alone as compared to some more quote unquote traditional investment vehicles like equities. But on the next slide, you talk about time in a few different ways as it pertains to returns, but also how it might take potentially more time actually in managing a property, especially and even more so if you do it self-manage your properties. You can ask any investor in any single meetup if they have managed their properties or if they just have had to deal with any tenant issues, and I would bet my hat that they have had at least one really nightmare story, which is just kind of it just comes with the trade. But there is a unique way to make this vehicle even more passive, and as maybe a little cliffhanger, but it just and this is really where our expertise lies, is in multifamily, i.e., one of the sectors in commercial real estate. And there's a unique specific structure that allows one to reap the benefits of multifamily without having to necessarily deal with, there's the quote in real estate, we say the 3 T's: tenants, termites, and toilets. But one that's probably even less the case in multifamily, but you don't have to be the one answering that. So we are looking forward to presenting how that might be possible. All of us participate in this specific way of investing. But it's just one component amongst other investments. So stay tuned. We'll be making an announcement for the next in this series. I think we're planning on doing this on a monthly basis. So Henry will show kind of the schedule.
Yeah, we're definitely doing a monthly schedule. We'll have to announce that news on the Facebook page. We do currently have the next event lineup for the middle of June, where we'll talk about the news and webinars roundup, where we go to many different seminars, webinars, and research firms that are updating us what's the latest in the real estate market. So we'll be talking about that on the June 16th. And we don't currently have a next co-investing meetup where we really dive deep into underwriting a property and dissecting everything from demographics to business plans to supply and demand and or the project sponsor. So we'll stay tuned for that as well. I think we do have, it is entering a Q&A session, and it looks like we do have a question. And Vivek, maybe you can help address this one.
Hey, Henry, can you hear me?
Yep, we can hear you now.
Oh, sure. Yeah, I think we have a question from the audience, Shobit. Thanks for your questions, by the way. He wants to know what kind of rental property, what tasks do rental property managements cover? Meaning what time investment is needed in terms of you as an investor in rental property? That's a great question, Shobit. It really depends on what your agreement or understanding is with the property manager. Some property managers can be helping you put a tenant in place, and you can answer the calls from the tenants after that. But more traditionally, for out of state investing and also someone who's looking for a more hands-off approach, you can hire someone to take a more active role in management of day-to-day activities. So they can market the place, they can get a tenant on, and they can be the first person of the first point of contact for the toilet fixing and everything that goes wrong in rentals. So the 8% figure that I put in as part of the example is sort of the market rate in the market that I have been focusing on for a full end-to-end sort of a property manager, not including the leasing costs. When I say leasing costs, it means usually they take half a month's rent to put a tenant in, and also maybe 25% of the rent if they renew a lease. So that's not baked into the 8% number over there, but you can get someone to do the end-to-end and not have to pick up the phone, but they still need you to check your statements quarterly and everything of that sort. So you can be as active as passive, but that's usually what the property manager is for.
Yeah, and some people really love, we've met a lot of owners that love managing their property. So it's really, that's just the beauty of real estate. It could be really anything you want it to be.
Absolutely.
Any more questions from the audience? I'm looking over the Q&A box. I believe we answered that question. I don't see any more at the moment.
And feel free to unmute yourself if you would like to speak as well. Oh, and let me also point you to our contact information and the Facebook group as well. All right. I think we're able to. Yeah.
Hey, I had one question. So I think Vivek just mentioned now that the property managers also have extra costs, like a 50% to get a tenant and 25% if they renew a lease. So what would the statement look like if you add those costs as well? So currently I see it's only 8% that's been considered for the property manager on monthly basis. So if you kind of amortize this 50% and 25% over a year, so what would those numbers be and how would that look?
Oh, that's a great question, Shubhaga. Thanks for the question. So usually what I've seen is tenants usually, if you select, if you do a good job on the selection and placing a tenant, they usually stay for about 2 to 3 years unless you jack up your rents really high. I would probably think that the price is going to be around the 8 to 10%, not too high if you amortize it over the term of your tenant. But the good thing is, even if you have those costs, you can still come off better, because what happens is the longer that your tenant stays, the lesser renewal, the lesser vacancy there is. So I would not expect the property management cost to go a lot higher than 10% on a standard 2 to 3 year lease.
Right. Yeah, I think that it kind of depends on the market. I think some markets definitely more expensive.
It does depend on the market, yes.
Yeah. I've kind of been seeing an average of maybe about 8% for single family.
Mm-hmm.
And, yeah.
I hope that answers your question, Shubhanga.
Yep, that did. Thanks.
You're welcome. Yeah.
Okay, we do have another question just coming in. So it says, what tips do you have for finding single-family properties? Do you look online on Redfin, Zillow, etc., or contact local real estate agents? Do you narrow down research based on location or based on the deal?
I think that's a great question. Do James or Henry, one of you want to take that, or?
Sure, yeah. I mean, I can offer kind of how my approach to finding single-family properties. I do believe location is most crucial, and actually, we have had learned something called the location magic from I.D.E.A.L that talks a lot about kind of choosing the right location, or first of all, finding the right city to invest in. I guess I'm assuming the question is it about finding properties in your own backyard where you're super familiar with what's around you, or are you looking out of state? So it kind of depends on the question. Of course, if you're looking for a property in your neighborhood, you may know a lot, but there's currently a lot of free websites and database out there that provides you such as population growth and job growth, which are two very strong indicator for how well the area will do in the long run. You will definitely want to invest in growth in those two, but also you may also see things like education and crime, how well the school compared to the state or the national level. So there's definitely a lot of information that you can go over, and some of these sites are actually free. You can go to citydata.com and look at the specific census tract to kind of see how well it's doing, and also not just now, but maybe for the last 10 years, because it also kind of show what it was in 2000 or 2010 and what it is today. So you can kind of see how well it's tracking. So that's just kind of more of a higher level research on the location. But once I kind of narrow down to kind of a specific area or city level, then finding real estate, I really would work with real estate agents as well too, because they do provide some. First of all, if you're not in the city, they will definitely be able to help you check out the property and kind of gives you more localized information. Things like in the Seattle area, we will definitely watch for rain, gutter, water issues is the number one problem. And so if you're not familiar with the climate of the specific location, you might miss out on things that you wouldn't know. So I would trust the local real estate agents, but definitely get a referral. Do you, Vivek or James, have any other recommendation you'd like to offer?
Yeah, just from my experience, it's been very relationship heavy, and also focusing a lot, kind of like what you said, Henry, on the sort of the fundamentals, the demographics and kind of market drivers in the area. But also, I tend to focus most on the areas that I have some sort of connection with. I've either lived there or I have friends and or family that are there, just so I can have both an objective sort of viewpoint and perspective, but also ideally kind of a personal perspective, like Houston, Dallas, Florida, and Kentucky. I've been looking at because I've either lived or been there before, or I have family there. But once I do find those markets, to emphasize Henry's point, I've had a lot of success working with realtors. I love networking. I love really working with people rather than databases. So, but I trust their local market expertise and really building that friendship to be working together and build each other's business. I think that goes a long way to really feeling confident that they are doing their work in your best interest. So that's my at least that's my take on it.
I agree with both of you, meaning there are national databases like Redfin and Zillow, but I think local market knowledge goes a long way. You cannot know how the area looks, or you can do a Google Street View and all that, but you cannot get a feel for the area unless you speak to someone local there, because one side of the street can be good, the other side need not be that great. On the other hand, besides that, the other thing that I'd like to add is, yes, there are national databases, but I think relationships are the key to getting deals done in real estate. And the more I analyze deals and talk to people, the more I understand that relationships are still the way real estate deals get done, even in 2020. So that's what I've understood on the real estate side.
Yeah. And adding to Vivek, there are also other avenues, but I do work with real estate brokers. But if you're more adventurous, there's definitely a lot of real estate meetup groups all over the U.S. And you might be able to connect with some of the local investors who might be able to guide you in kind of areas that to avoid and areas to invest in. And there might also be other people who are wholesalers that bring single-family properties that are off market. That might do better for your return. Of course, you still have to have the knowledge to really underwrite and analyze the deal, but also kind of the location, like what Vivek just said, not be on the wrong side of the street, so to speak. There's a lot of other ways as well.
Absolutely, and if anyone on the call who's attending needs, is interested in a certain market, then please do reach out. We have had some connections who either run these meetups or also invest in those markets. And I think the best way to understand a market is to talk to someone who already invests there, because they would tell you everything that is good, bad, and ugly about that market. Because the realtors want to get business at the end of the day. Nothing against them; they're the ones bringing you deals, but they're more on the sales side than the investors who know what can go wrong and what you can expect going into that market. I've personally learned a lot by just speaking with investors locally.
Mm-hmm. Yeah. Great point.
Yeah, I don't see any other questions, and we are right at the top of the hour.
Yeah, I guess we'll wrap it up, and thank you everyone for attending. As Henry mentioned, we'll be having our next Coast-to-Coast meetup on June 16th. So we'll be making an announcement for that, but mark it down in your calendars. We'll be happy to meet up there virtually, of course. But thank you all for attending, all your questions. If you have any other comments or questions, feel free to email or call us, and we'd be happy to share what we know. And we're wishing you a wonderful rest of your day. Stay safe.
Yeah. Peace out.
Thank you, everyone.
Take care.
Peace out. Bye.
Bye.